The 2008 global financial crash took the world by surprise. The stock market fell 50%.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5%. Let's talk about the speed with which we are watching this market deteriorate.
And millions lost their savings and jobs in the US and around the world. But one investor had seen the future and predicted the crash years ahead of it taking place. That man is Michael Burry, famously known from the book-turned-movie The Big Short.
The NASDAQ, everything and more has been completely wiped out. It was the worst day on Wall Street since the crash of 1987.
But what if I told you one of the best investors of all time was supposed to be a doctor? What if I told you this man had profited during each of the 3 market crashes in the last 25 years, not just 2008. Hi, my name is Maaiz. I'm a hedge fund analyst turned entrepreneur, and on this channel I share what I'm learning to build the best investment strategies. Doctor turned value investor. Before becoming a household name, Michael Burry was no slouch. He graduated from UCLA undergrad after majoring in economics. During his time at UCLA, he was torn with what to do with his life. He loved investing, but couldn't see it as a career. Michael Burry left sunny California to go to Vanderbilt School of Medicine in Nashville, Tennessee. After graduating medical school in 1997, he was accepted to the prestigious residency program in neurology and pathology in the heart of Silicon Valley at Stanford University. Unlike most of his peers who took the few hours they had after work to relax and kick it in front of the TV or hang out with friends, Michael Burry spent his precious free time researching companies. Burry's love for investing continued to grow during residency as he wrote thousands of posts on the investment blogs Silicon Investor and MSN Money. At the age of 29, it became clear to him that he cared more about investing than medicine. He left his residency program and started an investment firm with the little money that he had inherited.
So he started up a little webpage and people started paying attention. I think it was only like 50,000 that he got left after his father died, and then turned it into this just ridiculously profitable fund.
Within years of starting his hedge fund, he became one of the best hedge fund managers in the whole world, amassing over $600 million. Unfortunately, since Burry became famous for The Big Short, he has more or less exited the public world, with the entirety of his contact with the public over the last 10 years being in cryptic tweets that are deleted minutes after being posted. I spent the last week combing through his messages on Silicon Investor and MSN Money to find out what really differentiates Burry's strategy from everyone else who didn't call the 2008 financial crash. This is what I found. Michael Burry started investing seriously at the height of the 2000 tech bubble. All around him, he was watching companies become successful overnight in his own backyard, Silicon Valley. Up until then, he had been following the safe path to success with his medical degree in hand. But watching others become multimillionaires overnight all around you definitely caught his interest. On top of that, Michael Burry admits he wasn't very social. He'd prefer to spend time with himself rather than his classmates after work or class. He used that time to become the prolific investor he is today. Now, just telling you about Michael Burry's investment strategy would be boring. The devil is in the details, as they say. In order to really get inside Burry's mind and help you understand how he does what he does, I combed through all of his investment posts in the early 2000s, and I found the one that perfectly encapsulates Burry's thinking, which you might just be familiar with. Michael Burry invested in Pixar Studios on August 14th of 2000 at $33.75 per share. At the time, Pixar was run by the visionary Steve Jobs, and he had just begun to show the world the amazing potential of digital animation through 3 blockbuster hits in a row: Toy Story, A Bug's Life, and Toy Story 2 in 1999. At the same time, the internet bubble was in full swing, and people were excited about the power of computers and how they could change movies and the world at large. Despite all this, when Burry purchased Pixar stock, it was languishing near its lows. Despite being a self-proclaimed value investor, Michael Burry prefers to buy stocks near their 52-week lows, usually within 10 to 15% of the lowest point of the last year. You might say, okay, that's not so odd. Value investors like to buy cheap. Unlike other investors though, if one of his stocks breaks to new lows, after he's bought it, he will generally sell the stock and cut his losses versus holding. This is because he doesn't want to be on the wrong end of what he calls irrational selling. But why was Pixar stock trading solo after 3 blockbuster movies? It turns out the market couldn't deal with the fact that Pixar's next movie wouldn't come out for a whole another year, nearly 2 years after its last hit, Toy Story 2. On top of that, amid the frenzy of the dot-com bubble, where billion-dollar websites were popping up overnight, 2 years until the next product was just too long for most investors. As a result, investors lost their appetite for Pixar and sold for shinier stocks. Despite the market writing off Pixar, Michael Burry saw serious value in Pixar Studios. Value that, if anyone cared to look deep enough, was readily apparent. Michael Burry's strategy toward investing is 100% based on the concept of margin of safety, as laid out by Benjamin Graham in his seminal book, Security Analysis. Michael Burry says, "My weapon of choice as a stock picker is research. It's critical for me to understand a company's value before laying down a dime. I really had no other choice in this matter, for when I first happened upon the writings of Benjamin Graham, I felt as if I was born to play the role of a value investor. All my stock picking is 100% based on the concept of margin of safety." So what did Burry discover about Pixar that the rest of the market missed? First and foremost, Burry believed in Pixar's leadership. At this point, Steve Jobs had already made a name for himself as a visionary leader. At this point in the late 2000s, Steve Jobs was leading Apple and Pixar. He had proven his worth with Apple's 1997 acquisition of his company Next and his reinstatement after being ousted from the company in 1985. At Apple, he had released the massively popular iMac in 1998 and had become well known for his shrewd company management. Burry saw Steve Jobs' talent and wanted to bet on him if the opportunity presented itself. So when Pixar stock kept showing up on his radar as hitting new lows in stock price, Burry couldn't help but look deeper into the stock. At first, he noticed that the company wouldn't see any major movie release and box office income for over a year. Despite that, Burry saw other longer-term earnings potential. A Bug's Life was about to be released on pay-per-view. Toy Story 2 was about to be released on home video. And lastly, Buzz Lightyear, a star character from the Toy Story franchise, was about to get his own TV show on the Disney Channel. You can already start to see where I'm going with this. Rule 3, I usually focus on free cash flow and enterprise value, and that's market capitalization less cash plus debt. I'll then look harder to determine a more specific price and value for the company. When I do this, I take into account off-balance sheet items and true free cash flow. I tend to ignore price to earnings ratios. Even though Pixar had only released 3 movies, the life cycle and earnings potential of these movies was huge. Each hit franchise goes on to create opportunities for TV shows, merchandising, and sequels with die-hard fans like no other. You just can't ask for a more dedicated customer base than Pixar's. Last but most important of all, Pixar was cheap. Pixar was guiding to an earnings per share of $1.30. That in itself doesn't sound too cheap, implying a price to earnings ratio of 26, but Burry dug deeper to find that Pixar had $214 million in cash on hand that would bring that PE down to 21. And on top of that, turns out Pixar's free cash flow was consistently higher than their reported earnings. This is likely because of the depreciation and other non-cash expenses the company was using to offset their income. Taking that all into account, the price to free cash flow ratio that Burry really cared about was 14. At that price, the stock was about rightly valued if there was no future growth in the company. But so far, Pixar had been churning out one hit after another, and they'd hired enough staff to increase their pace of production dramatically going forward. And with Steve Jobs at the helm, Burry could bet Pixar would deliver on their plans to dominate the animation industry. Next rule, I also invest in rare birds. I'll happily mix in the types of companies favored by Warren Buffett, those with a sustainable competitive advantage as demonstrated by long-standing, stable, high returns on invested capital, if they become available at good prices. These can include technology companies if I can understand them. But again, all of these sorts of investments are rare birds. When found, they're deserving of longer hold periods. Last but not least, Pixar as a young studio had signed a pretty expensive distribution deal with Disney for its content, but that distribution deal was coming up for renewal in a couple of years. With 3 blockbuster hits under their belt and billions in revenue, Pixar was a Goliath on its own at this point and could get much better terms from Disney or a competitor. Going forward, Burry expected Pixar would get a 20% discount, which would increase Pixar's income by up to 40%. With so much latent earnings potential in Pixar at such a reasonable price, the stock qualified as a rare bird investment in Michael Burry's eyes. All Pixar had to do to beat the market's expectations was what it had been doing all along: release another movie and negotiate a fair distribution deal with Disney. So what actually happened with Pixar and Burry's investment in it? Since his investment in August of 2004, the stock rose a bit and really started to take off after the release of the Monsters, Inc. movie a year later. Steve Jobs played hardball with Disney and walked away from the negotiations to get better terms, and Pixar's next 3 movies were amazing successes. Finding Nemo alone would go on to gross $870 million in the box office, surpassing Toy Story's revenue by nearly 3 times. All the while, the stock doubled by 2003 and was up 4 times by the time Disney bought Pixar in 2006 for $7.6 billion. Surprisingly, Michael Burry did even better during this time. According to the author Michael Lewis, in his first full year at the hedge fund in 2001, the S&P 500 fell 11.88%. Scion, Michael Burry's hedge fund, was up 55%. The next year, the S&P 500 fell again by 22.1%, and Scion was up again 16%. The next year, in 2003, the stock market finally turned around and rose 28.7%, but Burry beat it again with returns of 50%. By the end of 2004, he was managing $600 million and turning away new money. Burry would later go on to repeat his success in predicting the markets in 2008 and most recently in 2023. To see what he's predicting today, check out my video deciphering his deleted tweets.